Picture this. You wake up tomorrow and discover that the safest investments in the world are suddenly not so safe anymore. Sounds like a nightmare, right? Well, for millions of investors around the globe, this nightmare might be becoming reality. The bond market, that supposedly boring, stable corner of finance, is sending warning signals that could shake the entire global economy. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, regional investment strategies, and everything related to growing your wealth on a global scale. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 950,000 reads and 57,000 likes. I've produced over 800 videos with more than 380,000 watch hours as of May 2025. I also focus on regional and global economic trends, helping international investors understand how major market movements impact portfolios worldwide. Today, we're diving deep into a crisis that many investors don't even know is happening. But here's the thing. This crisis could affect your investments, whether you live in Singapore, London, Sydney, or anywhere else in the world. We're talking about the global bond crisis, and trust me, you need to understand this. Let me start with the basics for those who might be new to bonds. Think of bonds as IOUs from governments. When you buy a government bond, you're essentially lending money to that country. In return, they promise to pay you back with interest. For decades, U.S. government bonds, called Treasuries, have been considered the safest investment on earth. They're like the gold standard of safety. But something strange is happening right now. Bond yields are rising across major economies. Now, when bond yields go up, it means bond prices are going down. Why? Because investors are demanding higher returns to compensate for what they see as increased risk. Here's what's really eye-opening. Many investors have no idea how serious the situation has become. The bond market, which financial experts often call the smartest money in the room, is essentially screaming that trouble lies ahead. And when the bond market talks, smart investors listen. Now let me tell you about something that happened recently that should concern every international investor. Japan, which holds more U.S. debt than any other foreign country, just made a move that sent shockwaves through global markets. Japan's 30-year government bond yield hit 3.13% in May 2025. To put this in perspective, that's like your safest, most conservative investment suddenly becoming risky. The 40-year yield also reached record levels. But here's the kicker, and this is where it gets really interesting for international investors. Japan holds about $1.13 trillion in U.S. Treasuries, making it the largest foreign holder of American debt. That's more than the entire GDP of most countries. And guess what? Japanese institutions have been selling off massive amounts of U.S. Treasuries. In April 2025 alone, Japan sold over $20 billion worth of U.S. government bonds during just the first 2 weeks of the month. Why does this matter to you? Well, imagine if the biggest customer of your local shop suddenly stopped buying. That's essentially what's happening here. But on a global scale, here's something that might surprise international investors. Even U.S. Treasury auctions are showing signs of trouble. Recent auctions of long-term Treasury bonds have seen weaker demand than expected. The 30-year Treasury yield has been pushing toward concerning levels, which reflects growing concerns about America's ability to manage its massive debt. For context, the U.S. government ran a deficit equivalent to 6.4% of GDP in 2024. Think about this for a moment. This is like a household spending 6.4% more than it earns every year. Eventually, creditors start asking questions. What makes this particularly concerning for international investors is that Moody's, one of the major credit rating agencies, downgraded the U.S. debt rating to A1 in May 2025. This is huge because it signals that even the experts are getting worried about America's fiscal health. Moody's cited several alarming factors: the $36.2 trillion debt pile, rising net interest costs, and political gridlock, making fiscal correction less likely. The agency projects that federal interest payments will absorb around 30% of government revenue by 2035. up from about 18% in 2024. This downgrade means all three major rating agencies have now stripped the US of its AAA status. Now let's put this in global context, because this isn't just an American problem. When we look at deficit spending as a percentage of GDP, the US leads at 6.4%, followed by France at around 5.8%, and the UK at 4.8%. Germany, which is often seen as more fiscally conservative, still runs a deficit. But here's what's really interesting. Some countries are actually running budget surpluses. Norway, for example, has a significant surplus. This shows that fiscal discipline is possible, even in challenging economic times. The problem is that most governments seem unwilling to make the tough decisions needed to balance their books. They're essentially betting that they can keep borrowing without consequences. But the bond market is starting to call their bluff. You might be thinking, Iggy, I don't live in the US or Japan. Why should I care? Great question. And here's why this matters, regardless of where you live or invest. First, US Treasuries have traditionally been the ultimate safe haven asset. When markets get scary, investors worldwide flee to US bonds. But if those bonds aren't as safe as we thought, where does all that money go? This creates uncertainty across all markets. Second, many popular investment strategies rely on the stability of government bonds. The famous 60-40 portfolio, that's 60% stocks and 40% bonds, has been a cornerstone of investing for decades. But if bonds become unreliable, this entire approach needs rethinking. Third, rising bond yields affect global interest rates. This impacts everything from mortgage rates in Australia to business loans in Germany. It's all connected in our globalized financial system. Here's something that should really concern international investors. Governments might use inflation as a sneaky way to reduce the debt burdens. Think of it like this. If you owe someone $100 and inflation makes that $100 worth only $80 in real terms, you've effectively reduced your debt by 20%. This inflation tax hits everyone, regardless of nationality. Your savings lose purchasing power, and this happens whether those savings are in dollars, euros, yen, or any other currency tied to these major economies. So what can you do as an international investor to protect yourself? Here are some practical strategies based on current market conditions. First, diversify beyond traditional government bonds. Consider real assets like commodities, which historically hold their value during inflationary periods. Gold, silver, and even agricultural commodities can serve as hedges against currency debasement. Second, look at dividend-paying companies in stable sectors. Think utilities, telecommunications, and consumer staples, companies that provide essential services regardless of economic conditions. These can offer defensive income when bonds become unreliable. Third, consider structured notes as an alternative income source. These have proven resilient during market turbulence and can provide steady returns when traditional fixed income investments falter. Fourth, don't abandon equities entirely, but be selective. Focus on companies with strong balance sheets, consistent cash flows, and the ability to raise prices with inflation. International blue-chip companies with global operations can provide good diversification. The key message here isn't to panic, but to adapt. The financial landscape is shifting, and successful investors are those who recognize these changes early and adjust accordingly. Traditional asset allocation models might need updating. The old rule of holding your age in bonds might not make sense anymore if bonds carry higher risks. Instead, consider a more dynamic approach that can adapt to changing market conditions. For international investors, this also means paying closer attention to currency risks. If major currencies become unstable due to fiscal concerns, having exposure to multiple currencies or currency-hedged investments becomes more important. Different regions will be affected differently by this bond crisis. European investors need to watch the Eurozone's fiscal policies closely, especially given the varying debt levels across member countries. Asian investors should monitor how Japan's policies affect regional stability and currency relationships. Emerging market investors face a particular challenge because their local bonds often become less attractive when developed market yields rise. Capital tends to flow toward higher yields in more stable currencies, potentially creating pressure on emerging market assets. One interesting aspect of this crisis is how it might accelerate financial innovation. As traditional safe havens become less reliable, we might see increased adoption of alternative stores of value. Cryptocurrency, despite its volatility, continues to attract investors seeking assets uncorrelated with traditional government debt. Similarly, fintech solutions that help investors access global markets more easily could benefit. The ability to quickly diversify across regions, currencies, and asset classes becomes more valuable when traditional investment approaches face challenges. As we navigate these uncertain times, there are several key indicators international investors should monitor. Watch bond auction results from major economies. Weak demand or rising yields signal continuing stress in sovereign debt markets. Monitor central bank policies carefully. The Federal Reserve, European Central Bank, Bank of Japan, and other major central banks face difficult balancing acts between supporting their economies and maintaining currency stability. Keep an eye on currency relationships, especially the US dollar's role as the global reserve currency. Any significant weakening could have profound implications for international trade and investment. Pay attention to fiscal policy announcements from major economies. Government spending plans and tax policies directly impact sovereign debt sustainability. The unfolding bond crisis represents a fundamental shift in global finance. For decades, government bonds provided the stable foundation that allowed investors to take risks elsewhere. If that foundation becomes shaky, the entire investment landscape changes. This doesn't mean you should panic or make drastic changes overnight, but it does mean you need to stay informed and be prepared to adapt your investment strategy as conditions evolve. The investors who thrive in the coming years will be those who recognize these changes early and position their portfolios accordingly. Diversification becomes more important than ever, but it needs to be thoughtful diversification that considers the new realities of global finance. Here's what I recommend you do after watching this video. First, review your current portfolio allocation. If you're heavily weighted toward government bonds, especially long-term ones, consider reducing that exposure gradually. Second, research alternative income-generating investments that might work in your region. This could include dividend-paying stocks, REITs, or other income-focused strategies available to international investors. Third, consider speaking with a financial advisor who understands global markets. The complexity of current conditions makes professional guidance more valuable than ever. Fourth, stay educated. Subscribe to quality financial content that helps you understand global economic trends. The more you understand these forces, the better positioned you'll be to navigate them successfully. Remember, every crisis creates both challenges and opportunities. While the bond crisis poses risks, it also creates openings for prepared investors to find better returns elsewhere. The key is staying informed, staying flexible, and not being afraid to question traditional investment wisdom when market conditions change fundamentally. That's all for today's deep dive into the global bond crisis. If you found this helpful, please hit that like button and subscribe for more international investment insights. I'd love to hear your thoughts in the comments. How is this bond situation affecting your investment strategy? And if you want to understand more about how these global trends might affect specific regional markets, check out my recent video on emerging market opportunities in uncertain times. It provides a great complement to today's discussion about global fixed income challenges. Until next time, keep investing smart, and remember, knowledge is your best defense against market uncertainty.